Your data quality defines your edge, which are the building blocks of quant strategy. India data is messy. Information is the best tip. You are not just looking at winners who survived, but also the losers that real investors faced. Trading in the stock market is like gambling when you rely on your gut feeling. But the same stock market could be your main source of income and wealth generation when you rely on data. When it comes to investing, most people think information is equal to news, headlines, quarterly results, RBI policy changes, FI flows. Therefore, I always say this to everyone who asks for tips. Information is the best tip. It's free. Just leverage information. Use your quantitative brain and see yourself grow your portfolio. In quant investing, information is equal to data. And in today's world, data is the biggest edge an investor can have. So why does data matter in investing? Let me simplify this for you. Think about cricket. A casual fan says, Virat is in form, he will score well today. On the other hand, Akash Chopra would look at Virat's batting average in the last 10 innings, strike rate against pace and spinners, and performance in that particular stadium. That's the difference between a gut feeling and data-driven quant investing. In capital markets, the same principle applies. If you're relying on gut feeling, you're gambling. If you're relying on data, you're investing systematically. Let's understand this deeply with types of data in quant investing. In India, we broadly use 4 categories of data. Number 1 is price data. Now, this is the open, high, low, close, volume, returns, volatility. While open, high, low, close are data from exchanges, returns and volatility are derived data. The return is calculated as a percentage change in price, and volatility is a standard deviation of the returns. Remember, it's not for price, it's for returns. Number 2 is fundamental data. Balance sheet, ratios like price to earning, price to book value, return on equity. Companies listed on exchanges are required to publish annual and quarterly financial statements. A lot of insights can be drawn from these statements. Balance sheets gives a view of assets and liability. Profit and loss statement gives revenue, gross profit, EBITDA, net profit, etc. Cash flow statements gives a view of where is the revenue coming from. Is it operational activity, financing activity, or investing activity? Third is the sector and macro data. Indices, inflation, crude oil, USD INR, credit growth, US Treasury yield. All of these factors are very important in a world of today where our economy is tied with global economies. There are a number of sectoral indices which reflect how a specific sector is doing. Auto, FMCG, banks, IT, etc. These are good references to reflect on business cycles as well as reviewing how we are doing. Fourth, not the least, it's the alternative data, becoming so very important. FI, DIS flows, shareholding patterns, sentiments. This is the most tricky piece as it needs to derive the broader asset allocation as well as sectoral and stock specific play. This is still nascent status because of lack of quality data availability, but would become important as more and more data becomes available. So what all data did we cover today? Price data, financial data, sectoral, macro, and finally alternative data, which are the building blocks of quant strategy. Now, each of these fuel different types of quant strategies, and we will talk about them later. So far, so good. Here comes the challenge. India data is messy. Where does the mess come from? Corporate actions distorts the prices. Many data sets exclude delisted stocks. Financial reporting can be inconsistent for smaller companies. Policy shock creates structural breaks. If you don't clean and adjust your data, your backtest will mislead you. So how do we handle this? Here's how we should process pricing data. We need to process dividends. Now, dividend is a type of corporate actions where companies distribute part of the profit to their shareholders. So when a company pays dividend, we need to adjust historical prices so that the total return, which is price plus dividend, are captured. This way, backtest reflects real investor returns, not just price appreciation. Second is bonus issues. At times, companies issue bonuses, shares to existing shareholders. If a company issues a 1:1 bonus, the share price halves, but the shareholder wealth remains unchanged. We need to adjust past prices and volumes to maintain continuity. Third is stock splits. Similar to bonuses, if a 100 rupee stock undergoes a 1:10 split, it becomes rupee 10 stock with 10x more shares. Again, we need to adjust historical data so that the stock return path isn't artificially distorted. Fourth is around rights issues and mergers. Now, these are factored into stock prices to address the dilution and consolidation. So what's the result? We get clean, adjusted price data that can be trusted for backtesting and strategy building. So are we good with data now? Absolutely not. There is one more data which needs to be addressed, and that is the survivorship bias. Most free or commercial dataset only includes stocks that are currently listed in the various indices. That means delisted or failed companies are ignored, making past performance look far better than reality. We need to specifically address this. How do we do that? We need to include all listed companies from the start of their listing till the day they got delisted. This ensures when you backtest a strategy, you are not just looking at winners who survived, but also the losers that real investors faced. Some of the examples are Yes Bank, Reliance Communications, Suzlon, and there are countless other small cap and mid caps which were part of index. Ignoring them makes backtest misleading. We don't make that mistake. So why does this matter? Let's put it simply. If you test a momentum strategy without adjusting for dividends, your return will be understated. If you don't adjust for stock splits, your return will be distorted again. If you ignore delisted stocks, your strategy will look much better than it really is. Clean, unbiased data is equal to reliable backtest. Messy data is garbage in, garbage out. Data engineering gives us a real edge. Let's look at few case studies. We start with momentum with dividends. In 2021-23, many PSU companies not only delivered price gains, but also hefty dividends. Adjusted returns showed 15 to 20% higher performance than raw prices. Second, delisted stocks in backtest. A 10-year backtest of small cap momentum looks amazing if you only include today's survivors. But when you include delisted failures, volatility doubles and returns come close to reality. This is why robust quant investing in India is not possible without the level of data preparation. So remember, data is the raw material of quant investing. In India, cleaning data is half the battle. We need to process dividends, bonuses, splits, rights, and even delisted stocks to ensure our strategies are based on reality, not illusion. Because in quant investing, your data quality defines your edge. Comment with what is the highest amount of money you have invested based on your emotional decision. And remember, sharing these strategies with your friend will only make them wealthier and a smart investor. See you in the third video. Thank you.